What's going on, guys? Welcome on into today's stream. Sunday, we have July 10th. So right now it is 7:24 p.m. Central Time, 8:24 p.m. Eastern Time, and we're looking at futures right here. A super hot day, by the way, here in Austin, Texas. Over 105. It was like 108, something like that. Crazy, like an excessive heat warning, but we cooled down just a touch, and now we're ready to go. Seems like futures are kind of slightly red. I mean, across the board, we're looking at everything being down, VIX being slightly up, but not that much. To be completely honest, we always talk about this on the streams, and we're like, okay, like what's going down? How much are we up? We up this much? We down this much? Is that notable? And anything under like 0.25%, really under 0.5%, isn't such a big deal. So we'll talk about this. We'll talk about the charts, talk about the overall market, and then a couple big hitters for this week, because we got some big stuff to talk about. CPIs coming up. We'll have a bunch of stuff to watch, a bunch of stocks to watch, because we're actually sitting at a really interesting spot across the overall market. And then on top of that, I think across a lot of individual stocks. I mean, in terms of breaking some substantial downtrends or breaking patterns, breaking back above their 50-period moving average, which, by the way, take a look at this. If we jump over to FinViz, we roll this up here, and what you're going to see on FinViz is that for the most part, we have 31% of stocks above their 50 SMA, but for the most part, most stocks, most companies are below their 50 SMA. A ton are below the 200 SMA, and I expect that to stay that way for a good time, unless we get a really big rally. And is this Wednesday's CPI maybe going to set us up for that? We'll talk about the reasons why it could and why it can't, right? Obviously, here in the stream. So let's dive in. Hope everyone had a great weekend and ready for a full week. No short weeks this week in the market. So that said, futures we talked about. Here's SPY. Let's get a big picture. This is the S&P 500 ETF. And what we see right here, let me close this up so we get it nice and clear. Okay, so here's the glaring gap. Glaring gap fill up here. That's the biggest question of the week. I mean, are we going to potentially fill this gap? Now, how do we do that? How do we get up there? How do we get to fill that gap? It's not that far away. It's about $12 away to fill that gap. It could obviously happen Monday or Tuesday. And if it does, great. It happens before CPI. But if the market is super low volume and we kind of chop around going into CPI, which I think is very possible, we don't fill that until potentially after CPI. Now, how do we do that? Well, when it comes to CPI, if that CPI comes in massively high, up towards, 9+%, I don't think that's going to happen. Market's going to be fearful, and it's very possible the Fed may have to step in and do an emergency rate hike. I don't know if they'll do that, but it's, either way, come the end of the month, come, 2-3 more weeks, when they do have their next meeting, their next hike, they're probably going to continue at the 75 basis point pace, and potentially, if it's really bad, dare we say 100 basis points. I don't know. Anything can happen if it's really bad. So do we think we're going to get a move to the upside if that's the case? No. But if the number comes in close to expectations, that could be very good for the markets. And we'll explain why. Because the market's forward-looking, right? And if we look ahead to next month's reading, and you look at some things like oil, by the way, which is sitting here at a very interesting spot. If it breaks to the upside, we're going to have to watch that, or it's potentially about to fail this trend line and break back to the downside. If it does, let's say oil does come down and fall off, or even if oil does bounce up and it's kind of in this range, well, guess what? Oil has come down a ton off of where it was. Well, relatively speaking, based off where it was up over 120, it's pretty substantial being down here under 105 right now. But that's not going to be played out. We're not going to get a good feel for this unless it stays down here for the month of July. So far in July, hey, you're off to a great start in terms of oil prices, CPI, gas is coming down. Now there's a delay there, right? So oil started to kind of collapse a little bit here, really since June 14th. So about a month. But if you go over and look at, let me see if I can find the gas prices. If you take a look at gas prices, they've come down a lot. So the highest nationwide average we saw was right here at just over $5 a gallon, and that was on the 14th, which is funny, guys, because look back to oil. Well, oil peaked on the 14th, okay? And then what has oil done? It's come down. So what gas has done too is it's come down. So this is going to be a player in the CPI and oil overall. So if this doesn't have to necessarily stay down here, but if it stays under like 110, and potentially, let's say it goes off even lower, I don't know, that's going to be very helpful in the next month's reading. So that's going to bring those numbers down a lot. Or if it just kind of flatlines, right? It's going to start changing or showing the price increase month to month is going to start to kind of, subside, either go negative or kind of flatline. And that's going to be helpful in the CPI reading. So that's where the market's going to be looking ahead to, right? So if this number comes in like in line with expectations, market might look ahead and say, you know what? Well, gas has come down a decent amount. Oil's come down a decent amount. If those stay relatively low, that's going to be a pretty big help in CPI, because you have other categories that could come down, but the weights and the weighting of that isn't strong enough to bring down the overall CPI number, which seems like the Fed's reacting off of, even though they say they don't necessarily read off of that only, but it seems like they are reacting off of that. So here's a couple articles I want to pull up. So Reuters, they come out and they're actually projecting, economists there are projecting a 8.7% CPI readings. That will be the highest reading we have seen this cycle. So we got 8.6 last month. Now they're projecting 8.7. Believe it or not. But market's not stupid here. Market knows this. It's not like the market's like, oh my gosh, 8.7 comes in and it's going to tank. Like it could, obviously it could, but anything could happen. But it's not like we wouldn't have seen this coming. The problem we had the past couple of readings, where we are, especially last reading, where we got the 8.6. I believe the projection was in the lower 8s, 8.3, 8.2, something like that, wherever it was, maybe 8.1. I forget what the number was. The projections were down lower, and it missed. I mean, we missed to the upside substantially and hit a new high. That wasn't good. Fed came out, boom, rate hikes, and we went from a 75. From the thought process being, we're going to do a 50 basis point hike consistently, to saying, okay, no, 75. Market just immediately said 75. So if we go, I would say if we go up in the upper 8s to, let's say 9, something like that, like I would say it's possible that the market starts pricing in a 100 basis point hike for the July meeting. It's possible. Would start getting substantial, right? We start doing that, then something's bound to break pretty soon. But we'll see. Then we go to Bloomberg here, and Bloomberg, this came out on July 9th. So this is actually yesterday, 3 p.m. Central Time. This popped up, and what they're saying here is the consumer price index probably rose nearly 9% in June. Okay, so essentially they're coming in and saying, upper 8s, so 8.7 to 9, right, is somewhere in your range. Even maybe low 9s is where they think it's going to be coming in. So believe it or not, right? Whether this number that comes out, let's say it's projected to be the highest, that's not going to surprise the markets, because it's currently we're actually economists that are predicting it to be. What you want to see, obviously, is a couple months in a row that it starts to come down. So 1 month, one-off run is not going to be a big deal. Market's already seeing, I believe, the oil situation. So we'll have to monitor that, how oil, gas prices all shape up. Because it's seeing this, it's not like, oh my, like this is surprising everyone, or it's not like, it's a big unknown factor, but the market sees this, right? The market's going to be like, okay, well, yeah, sure, this month's pretty bad, but next month's actually going to be pretty substantially lower if this holds up. And, we're halfway through the month almost, so if oil stays down, it's going to be good. So that's why, I just don't get too caught up with, oh my gosh, CPI comes in, we hit a new high, immediately short everything, because maybe that works out, but if you do that and it goes the other way, well, looking forward is probably the reason why that ends up being the wrong decision. Not saying that that's going to happen, but that's certainly a possibility. So that is a quick little intro into kind of what's going on this week in terms of that. I also want to pull up one more other thing, but hope everyone's doing well. We'll talk about Soxel Sunday evening. What is going on? Everyone in the chat, we can look at Soxel gap fill around $18. Let's look at it. Let's look. SOXL. Boom. Pull it up. And let's see. Yeah. No, there is. I would say I wouldn't look at the 3X ETF for the gap. I would look at more of the SMH, the actual ETF that this 3X is essentially playing off of. But yeah, there's a gap right here. So here's your spot. I would say from like up over 1750 up to about 1850 plus. There's even a small one up here towards 21. I mean, those are very possible spots to get filled to the upside here soon. Just like this one right here got filled back to the downside eventually, so those are solid spots to watch. At least spot to watch on that chart. That's been a pretty nasty performer the past couple of weeks. It's been, hit hard after the last CPI. So we'll see how that ends up shaping up. But we're looking at oil. We can look at futures again here in a second and look at the chart and how that's playing out. But this just really quick, by the way, is exceptionally oversold. I think at some point will behave very, very similar to Labu. The problem here is the timing, and look at the volume too. I mean, everyone's here because this thing is moving so much. The volume has just been absolutely incredible, really, on SOX. So these 3x ETFs have been getting tons of volume. But this will have an XBI type of, or a Labu type of run at some point. I would just say SMH, right? At some point, whether it's a bear market rally, whether it's, an actual reversal, who knows? But here's SMH has 2 gaps to fill. I'm watching right here, and so it will. The question is going to be timing that. Did it already happen? There's a gap fill back to the downside on SMH right here. Maybe that has to fill before we can go higher. A lot will be it'll be very, very crucial to see how these areas shape up. My only concern, well, not my concern, but the biggest question, right, is going to be how we handle the CPI. Like, we might end up dumping off of CPI this week, right, on Wednesday. But do we hold a higher low on SPY? Like, do we hold higher lows? What sectors take bigger hits, than others, right? And being able to kind of see where things are playing out. Because what we're seeing right now is tech, small caps, and some growth names have actually been quite strong. Selective stuff, not everything, but there's actually been some good strength across a lot of those names. I mean, by the way, if you look at ARK Invest, just because it's a good kind of proxy for a lot of that stuff. It's breaking out over the 50 SMA. It's actually bottomed out pretty nicely, really, since mid-May. So while everyone's saying the market sucks and complaining and screaming at Cathie Wood sucks, this and that, this may have just been bottoming. And, again, we always talk about sentiment. We can pull up we can pull this up. I think it's actually really good to do. Let's see if I can pull this up. I want to pull up the chart for investor. I think it's investor psychology graph. Cycle. Here it is. So this is obviously just like, a chart to look at. It's not, doesn't, mean everything, doesn't mean the world, right? But it's cool to look at. And so just from what I'm telling and what we can tell, obviously we could look back at this and say, oh, well, we were only in like the anxiety phase or the denial phase or whatever, because we could be rebounding, right? But it kind of seems like, while everyone's kind of complaining and stuff, like you have this depression phase, right, for Cathie Wood, and that's kind of what it was the past like 2 months. And it's starting to kind of slowly kind of turn the corner here. Now, obviously going into CPI, a lot could change in like 2 seconds, but it's starting to kind of bottom potentially and turn the corner. We'll see if that ends up being kind of that disbelief phase and we do rally off of this. Sentiment has been so bearish. I mean, it just, you can't deny that. Let me pull up the AAII Bulls sentiment survey. So this is the past week. So next 6 months, you're 19% bullish, 52.8% bearish, and then 27% neutral, 28% neutral. I mean, this has been, substantially low for so long. And I mean, going back through history, you can look at this through, a lot of different lenses, but you go back through history and, the trends will tell you, obviously, yeah, this time is different. Everyone's always going to say this time is different. Yeah, sure. Every time is different, No shit. Sorry. It is, right? Every time there's always different factors into every situation. But when we're down here, based on everything I've seen, history says that your next 6 months, your next year actually tends to be more green than red, right? Much more green than red. So we'll see. We've been down here for a long time though. So it's been like this for months, it seems like. So hasn't been necessarily, although the past, month and a half, depending upon where you've been, it's actually been much better, stronger, or at least more of a consolidation, less just straight down moves than we've seen since the beginning of the year began. So we'll see, but that's the deal there. Gold bottom now, time to get bullish, load the boat. Let's take a look at some of that stuff. I haven't looked into any leverage ETFs for gold. I'm sure there are some out there. I'm sure you can play individual plays. There's small cap plays to play as well. But let's look at gold. So let's jump over to gold and see what it's doing. So gold came in, broke this trend, right? We had this key spot right here, broke down, cracked down, not looking good, right? Obviously. But now it's coming down and holding up around the 1735 or so area. Couple lows going back over the past couple of years, 1720. We have some lows down here to 1680. So those are the two spots. I'm going to draw two lines at those areas, horizontal lines. So 1680s, a good spot, and then this double bottom back here from September of 21, 1722 or so. So those are the next spots I watch on gold. But yeah, we'll see if it can regain some strength here and turn up to the upside this next couple of weeks. Obviously, gold, when you're looking at gold, it's not like, oh my gosh, it's moving so much today. Bigger picture. We're looking at a bigger picture on that. Got my eyes on CCL. I've been liking. I like it a lot too. I mean, I have obviously, a position there. Nothing crazy, but I have a position there. I do like it. I bought some September calls on this thing. Obviously, you have the risk going into CPI. So we'll see if this stuff bounces. I mean, best case scenario, right, would be for me and just in general for a really good feel on the market, and at least how I would want to position things. It never always works out this way, but best case scenario would be green Monday, Tuesday. If we get green up Monday, Tuesday across the board, and we have 2 nice solid days, 0.5% to 1% green, maybe more, I don't know. If that's the case, great. Any short-term calls, any calls that I have out till September, any calls that I have out to, I don't know, maybe I have some August. I actually have one left of August that I scaled out of. Anything like that, I'll sell. I'll trim some other stuff and I'll hold a decent amount of cash because I'm already net long as it is, but I'll just trim and sell, and then we'll see. And if CPI is really, really bad, there will be a good chance that we can make more money off the backside here. That it won't just be like a one-day dump. So we'll see. There could be opportunities to short some pops from there. So we'll see how the market reacts off that. But ideally, what I would love to see is 2 green days and then sell a lot of longs, trim out of longs, and then any short-term stuff. And then let's wait. There's no, you can strangle it. You can play, for both ways. I don't really care to do that, to be honest. Maybe there's something that I will see if I really like, but I probably won't do that. I'll let CPI come out. We'll see what happens, and then we have cash to react. So if it's really, really bad, maybe there's an opportunity to sell the open, right? Just essentially everything just dumps at the open, and then it's a trend down day all day on Wednesday. And if it is, there will be great opportunities there. If not, we'll see how things react, see if the market can build higher lows. And I would be, if we do see strength, here's my take. I mean, whether you like it or not, and you think we should go up or not, right? On SPY, if we do see strength somehow, or let's say it pulls back, let's say SPY pulls back, but it builds a higher low right here at this 380, prior low is back here and it starts to bounce at 380 this week or something like that, I would go long versus 380. And then obviously if it falls below, we get out, right, whatever, but I would go long versus that because we have the potential for a pretty substantial short squeeze because I think a lot of people are positioning themselves short into CPI because guess what happened last time? And when it doesn't happen the same way, wait, what's going on? And then all of a sudden you start seeing a little bit of short covering. And then now the eyes start to shift to the next CPI. And we know that's probably going to be down substantially, at least relative to what we've been seeing to the upside, because you go look at oil and gas and say, oh, well, that's come down. So those numbers should actually start to get better, right? And that's a pretty big player in CPI. So that's another, kind of area to set up for a watch this week. 380, if not 380 down here towards 372, and then below that. If we go below 370, my gut, on this, we'll see how the market reacts and see how it looks and whatever. But if we go below 370, obviously there's always the potential for a double bottom to form down here towards like the low 360s. But below this area, I'm going to, I would position myself obviously for the move down. I would put a stop loss here at this 372, maybe 373. On a put play, but I'd be looking to sell puts or to buy puts and then sell those puts right into extension into a break of new lows, a breach of those lows will be the move. Like let that thing kind of waterfall off and boom, if we get there. So that's kind of 3 scenarios, right? The first scenario will be if we fill this gap and things get going, probably won't touch anything, and then if we do really start seeing some good strength to the upside. The better risk reward at that point in time will not be playing SPY calls, SPY puts, maybe for day trades, sure, but for swings will probably be individual stocks, individual sectors that get hot, maybe small caps, maybe some momentum plays, growth names. If you're looking for short-term swings or whatever you're looking for, if we start getting to the upside, if we do pull back, hold up, start showing some strength here after CPI, everyone's like, oh man, it was so bad. We came in at 8.7. Guess what? Market's going to tank. Market pulls back off the initial kind of freak out, oh my gosh, panic, and then all of a sudden it starts to hold up. Build higher lows, all of a sudden you can get in the next couple of weeks a pretty nice bear market rally, squeeze some shorts out, make everyone go, oh my gosh, we're going green now. It's time to get long, and then that's when you want to play it short, obviously, or reverse that or sell into that or whatever. As you kind of can see, and you get a feel, right? And we can get a better feel for things going forward where the crowd's at. Right now, obviously the crowd wants this to tank. Obviously there's long-term investors, right? And everyone wants their stocks to go up. But if you're looking for the short term, this tells you enough right here. If you want to talk about where people are positioned, people are like, I'm more than happy to buy puts. I think we're going to go down. Inflation's so bad. All this stuff, right? And so when everyone's flipping that way, once we start to kind of see some signs of it maybe not working out, there could be a nice squeeze to the upside. So we'll see. That's kind of the situation we're watching. But again, those are the downside levels that I have. Obviously, I could draw them in with horizontal lines, but I like to draw them in this way sometimes just to see them a little better. They're a little thicker, but that's the deal. Let's see. BA has some range. You know what? We're going to get, I think we have United. One of the airline plays or some airline stocks have earnings this week, so we should get a good feel across that sector. But let's see how Boeing's chart looks. Boeing has been kind of looking decent since May as well. It's actually held up pretty well. Crossing the 50 SMA, kind of building these higher lows right now. Believe it or not, had this pretty substantial dip right here. I think if Boeing dips down and doesn't breach below the 115 area, that's going to be kind of your inverse head and shoulders potentially setting up right there on Boeing. Just something to think about. Here's your left shoulder. Here's your inverse head. Now you want to get this thing. If it pulls back, maybe it doesn't pull back, doesn't have to. Pulls back into here, but it holds up. That's going to be a really good reversal pattern if it happens. Something to think about on Boeing. HYMC, yeah, there's that. I think there's a lot of minor plays if you're looking for some moves there across gold and some small caps. There's a lot where that came from. But, all right. Good dip tomorrow morning. Long's looking better. The CPI is going to be... That's my biggest thing is going to be, even if we do come in with a lower CPI, market's going to like that, I guess, compared to, let's say, last CPI. We come with a lower CPI, that's good. But I don't know. I mean, I'm not really... You want to see 2 months in a row. I think we kind of know next month is going to be down. I mean, we kind of know that. Obviously, the lasting or the effects that are slowly starting to trickle in from these rate hikes are going to be taking hold little by little. They're lagging, though. So you raise rates. It's not going to affect CPI next month necessarily. You know, how do you affect CPI in a big way next month? You dump oil and you dump gas. If those two come crashing down and now they're down 10% from where they were the prior month, it's going to help a ton in that CPI reading. But from month to month, raising by 50 basis points or 75 or even 100, right, is not going to change anything. Not going to change very much next month. Down the road, 3, 6 months, 9 months, yeah, it's going to have an effect for sure, but it's not going to necessarily change things next month. One thing that's also interesting here in the Bloomberg article, I believe if we scroll down, what they're looking at here is here's a quote from a Bloomberg economist. After employment data showed labor market remains rock solid, surging gas prices will push June's headline CPI to a fresh high. Even with growth slowing, the underlying shift towards services will prevent the economy from falling into a technical recession in the second quarter. So they believe, hey, we're not going to see a recession in the second quarter. Like, we're not going to get negative GDP reading. Okay, we think CPI is going to come in higher, and we're not going to get a negative GDP reading this quarter. Markets, economy's too strong for now, but maybe the writing's on the wall later on. They think that the Fed will consider the 75 basis point hike. Okay, great, cool. Here's the GDP now, the Federal Reserve Bank of Atlanta. I just thought it was interesting to note. They are currently estimating GDP for second quarter to be negative 1.2%. They are at the lows had like a negative 2.1% number, but they actually pulled that back up to negative 1.2 after, I believe, seeing the employment or the job numbers last week. So that moved them back up 1%, but they're still forecasting a negative GDP reading for quarter two, which would put us into a technical recession. And the date to watch for this, I believe, let me pull it up. I believe is the 28th. Let's just double check that though. I believe it's the 28th of July. Yes, gross domestic product second quarter 2022 advanced estimate is 20th. So 8 we'll do a stream for that. July 28th. Set your your calendars for that. Not that I think that should be a big deal. That's a Thursday, July 28th. Not that I think it should be a big deal, but to be honest though, the freak out or the panic that we hit a recession, could be interesting to see how the market reacts to that, right? And again, these come out. So the quarter ended in June. That this is coming out, about 4 weeks later, and it's their advanced estimate. The next 2 months, there will be additional estimates that will kind of dial it in. Okay, can we get a better picture view, or do we have to adjust certain categories? We have to adjust certain numbers on GDP. So we'll see. So you might, if you're close, if you're at a 0.05 or something like that, crazy low or whatever growth or GDP increase or decrease, it's possible that you won't know if we're technically in a recession for a few months later until we get the official numbers and things kind of eventually clear up. So that is the deal across that. But we'll see. Yeah, Bloomberg expecting CPI at 8.9. So there's that. Reuters or whatever is 8.7%. So that's kind of the range. 8.7 to 9 is kind of like the spot. Again, interesting because, well, it's something to think about, right? Because they're essentially saying we're gonna hit a higher number. Now, why is it the case? Because look at gas. We hit the highs on June 14th. So you had the highs there. That's come down a ton. Gas is now down. Well, relatively speaking, is down to $4.68 a gallon. We'll see if that continues if oil stays down. Oil's down a good chunk off the highs too. That happened the second half of June and into early July. So again, was it enough to counteract how strong these things started off the month of June? Probably not, which is why CPI is going to come in that high. So that's going to be key. And of course, next month, we know these numbers are going to come down. So we know they're coming down next month. So again, the thing is, going into the CPI, how does the market react to where this comes in, knowing that next month is probably going to be down? Right? Anything can happen. If oil rips, crazy, it's possible it goes higher, right? But that's the biggest key. I'm really curious to see what happens. And anyone who says that they know what's going to happen has no idea. Everyone has to take their best guess, right? But I think that there's a couple scenarios as we talked about, and based off what happens, there's opportunities across all of these scenarios. To me, I just don't feel like the risk reward. I just don't feel like I have an edge really at all. So I don't feel the need to try to guess the direction, right, going into CPI outside of maybe a small hedge or something like that, I guess is fine. So we did last time we had a bigger hedge, not really a bigger hedge, but we had a hedge then that paid massively. And it worked out, and then it ended up giving us some cash to buy the dip, and then we bought the dip, and then things have pushed up, and we've taken some profits, and that's kind of the nature of playing these downtrends. There's obviously money to make in the downtrends. You got to take time to make it, swing puts and you're good, or swing shorts, yeah. But so those three scenarios, right? Just really quick again. We have the CPI, we fill the gap and go higher, right? There's that scenario. And it's like, oh my, no one sees this coming. And then all of a sudden everyone's looking out to next month saying, well, CPI is coming down. So we've hit the top, right? Officially, we almost know we hit the top, and there we go. There's that scenario. Scenario 2 is we kind of pull back off the CPI and then we start to build higher lows. It's like, wait a second. Next thing you know, right? That's just an exaggeration of where we could go. I don't know. Maybe we don't go that high. Maybe we go higher. Maybe we don't go that high. I don't know. But if the dip gets kind of bought up and all of a sudden everyone's in these shorts and then the shorts don't work out and everyone's starts getting squeezed back to the upside, boom, there's that scenario. And then there's the next scenario is we just kind of break down below these levels and we keep breaking down and we probably break below this 370 and then make a new low. My guess, obviously, below 370, there will be some support here down towards 362 on SPY. If that breaks, 350s, boom, you probably get a nice clean flush into that level. So how I would play it, and if the SPY puts or the calls are too expensive, be careful because things are going to be pretty expensive if the VIX spikes back up and everything. If they're too expensive, well then go play SPXS, SPXL, SQQQ, TQQQ. Those option chains are pretty darn liquid. And on top of that, the price of those ETFs are a lot cheaper. Now they're 3x ETFs, so you can play those with just shares, and that's one way. Or you can play puts and calls. It's going to be a lot cheaper to play that. So on that front, let's say you go and look at like a TQQQ. I don't know. Let's go look at them on Webull. Let's pull it up and see. If we jump into here, let's go look. And so let's say I was to look at like an SP. Let's go look at SPXL. Or SPXS is the bear ETF. So let's say I think the market's going to go down, right? I buy SPXS. What is this? This SPXS. Let's see. And I look over here, and it's the bear ETF. Yeah. So, okay, I look over here. I think that the market's going to go down, right? So this is going to go up. This goes up, and the market goes down. I can go do whatever I want. I can play whatever I want. I would go out to August 19th. I would not play, the July 15th. I would go out to August 19th, and I would say, okay, I want to go buy, a $30 call, and it's going to cost me $100. It's $1, about $1, $100 per contract. Rather than going out and buying some SPY puts that are, that have a decent chance of hitting if we do keep going lower, and having to pay 10, 20 bucks sometimes, or, whatever, 10, 5, 10, 15 bucks a contract. Well, that's $500,000, $1,500 for a smaller account. You can't scale into that, scale out of that, right? So maybe looking at these are better. So the 3X ETFs are your friend if you want to play that type of stuff, to the downside. So you don't have to worry. You don't have to like, oh my, I can't play SPY puts because they're too expensive. No, go play SPXS, go play SPXL, puts, calls, either way, right? It doesn't matter. I can play SPXS calls mean I think the market's going to go down. These go up when the market goes down. I can play puts here. If I think the market's going to go up, I can buy puts on SPXS, same thing. 6 of one, one way, half a dozen the other, same thing. As much as I hate that saying, right? That is a valid statement, I guess, for that. So, yeah, that's an idea. Short oil drip. I do have a call there. The only thing with the oil is that, we're at this trend line. I'm really excited to see what happens this week if this trend line rejects. If it does, there could be a really big downside move. I think 200 SMA test down here, low 90s is going to happen if this really rejects hard, And all these oil moves, though, have been hilarious because it's, it's like we're at these crucial spots, and then once the day starts to kind of go, just the fire hose, these things unload is kind of how it seems like. So we'll see if oil does, I wouldn't really worry about it until tomorrow, until the market's opening up tomorrow. So there's drip. I have that personally. I have a little drip position. I was looking to potentially add into that this week, but I have that. So we'll hold up on that for now. July 28th could be a trade pile. Yeah, it's possible. It's possible if that does end up shaping up to be a negative GDP reading, right? New York City here, happy, paid only $4.79 in gas. It's funny, I was looking around here in Austin. What is the average in Texas? It's still over $4 in Texas. But I remember we paid, what was it, a week ago? Literally a week ago. We paid $4.59 or something like that. And then maybe it's 460. Yeah, I remember seeing 465 or 469, and then it was like I know this other spot, so 459. Paid that. And then I think the same place was down under 4. Like, I was like, what? 399? Like, it's nuts. This a week later. Like, it's insane. Like, some of these crazy moves back down. Average in Texas is still here at 425. So it's still probably a rarity to see stuff under 4. But there are out there. Some of them. I was seeing some stuff on Twitter this weekend that there was a bunch of people who were, taking pictures of spots that were back under $4 a gallon, which is kind of cool. But 479 in New York City seems pretty good, to be honest. So it's average is 480, so it's not bad in New York City. CLSK aside from movement with Bitcoin. Let's take a look at that. Let's see. Let us see. I think CLSK, why does that one sound familiar? No, we were talking about something else. It was something else last week that was popping. It was something else. It was CLVS. This chart doesn't look too shabby. In terms of a curl. Now, obviously, right, we have yet to have a really big rally on this guy. So we could be setting up for 150 SMA, 540. So up over 525 will be kind of key. Was the prior high right here. You got to start to break out. You got to breach above some of these highs. Here's the thing. Notice this chart, right? Pop. Okay, pop. What are all of these pops to the upside? So, and this is so far. This one is so far. So we don't know if it's necessarily made its next high yet. They're all lower highs. So you got to break this trend. So you got to break up over 525. That's kind of your line in the sand. Until you break that trend, that's been the trend. So when you do that, then all of a sudden, the eyes start to shift. Okay, the trend's broken. Now what happens, right? What's going on? Big picture, macro. What's going on with the overall markets? What's going on with Bitcoin? What's going on? Are we seeing higher lows? Price action? How's the volume? That could build yourself back in. But until then, you're just still downtrending. So until that breaks, that downtrend is still valid. So, even though it's not like, I could draw a nice trend line, right? It's still the pattern. It's the downtrending pattern. Higher, these lower highs. That continues. So that's the deal. Gas and Cali, still 6. Starting to see a little tick down, some 590s. Okay, that's cool. Yeah, I definitely feel bad for you guys too out there. It's like Texas is, kind of lucky here, I guess, given location wise. And it's I don't really, to be honest though, we don't really use too much gas as it is, but still slowly get better. Markets are green Monday and Tuesday. I would sell some stocks and keep some cash. I think that is a good idea. Now, here's the thing. It would not surprise me, and I really wouldn't be surprised if, because everyone's so bearish, especially with CPI, that like things somehow just go higher. And so everyone who takes profits on Monday and Tuesday and sells and buys puts gets screwed the next couple of days. It wouldn't surprise me. But the smart move going into an event like CPI, which we know what can happen, right? Look what happened last time. We dropped like 10% in a matter of like 4 trading days off this, or really around the CPI time frame. So a lot can go down in a nasty fashion. So that's my plan, right? It's to sell any short-term longs. And then if I'm looking over, I'm saying to myself, okay, like let's just say, it's Tuesday afternoon and I'm sitting on my XBI. XBI is at like 87, 88. I don't know. I'm probably going to dump a couple contracts of Labu. Probably going to, even though they're January expirations, I'm going to dump a couple of those just to lock it in and feel safe, and feel a little bit better going into CPI in case this unravels and this thing was to go like this and this plummets right back down. I don't know. Just in case. And obviously we saw what it can do. It could do it again. It can bounce right back. But I would be just taking some gains on some of these things just because I don't want to have the risk in the CPI. So in a perfect world, market's green tomorrow and Tuesday, and then you can lock gains, position yourself. Honestly, depending upon how green it is, I wouldn't be opposed to getting a hedge if we really push up. If we push up into that gap on SPY, so if we did get up into this, 400-ish area, that's a spot to go short, in my book. If we got to like 400, risking, 401, 402 essentially, or at least hedging yourself into CPI if it happened before CPI. But that's the key. So I don't know. We'll see how that shapes up. A lot can happen tomorrow and Tuesday before CPI. But if we do get some of those big moves, then it sets you up. If we just chop along, there's not much you can really do. So we'll see. DC 489 cheapest, but most places 529 plus. At least some under 4. At least you could get it under 5, right? Which is good. EVFM, this thing is popping off obviously with all of the recent news. They are a non-hormonal birth control related company. I have some experience with them back in the day, when I played them and got destroyed. Actually, I don't think I got destroyed, but I made money on them a couple of times, and then they had a pretty nasty, essentially just a huge debacle. It was what it was into their product launch, which was a mess. CEO selling shares into a product launch like that just gives the investors great confidence in your company. Oh great, but this, by the way, look at this. So this thing bounces off the bottom, dead bottom. Dead bottom is like an offering, whatever it had, dead bottom. Bounces massively from 30 cents, hits up to over 150. Killer play. For those who caught that early, I wasn't even thinking it, wasn't paying attention. Since then, building higher lows. So you're continuing to build higher lows on this thing. 50 SMA sits here at like $1. As long as it holds over $1, in my opinion, it's probably okay. Just got to be careful though. I would say this is a play that is probably not going to necessarily go anywhere in terms of the news cycle. Probably not. But if you start to push up and continue to squeeze out to the upside into these extensions, if we get a big day, big green day or whatever, I would be selling into that. Just my personal thoughts would sell into that. But it's still holding up nice, building higher lows. $1 now is your 50 SMA. 50 SMA is like 95, but that'll eventually, $1 is going to be kind of a psychological spot. Your key spots now are 150 and then this 158, 157 are the two spots to break back to the upside. There are some gaps to fill here. Just be careful though. It's up a lot in the past couple of days. Just be careful. But this is a gap right here from like 150 up to about 165. And then there is like one small one up here towards like, what is this? 225 to 240. So 240 could be an interesting spot if it really gets going as a nice PT profit target. If it keeps going parabolic and the volume stays, then the volume isn't pretty nice. So the volume continues to stay above, what we've been seeing. It's good to see. But, yeah. So, let's see. MP, let's take a look. MP Materials. How is she shaping up? I haven't followed the fundamentals behind a lot of these guys as of late, but this has been still kind of like decently strong. So it's got this low right here, which matches this low in October. So what does that put you at? Like roughly $29 support right now. That's kind of a key spot. $29 is going to be key. If that holds, it's looking decent. So I would say that. But earnings, when is this earnings going to be? August. So you got earnings in a couple weeks. Yeah, what is this going to be? Why is it not working? Why is it not like just letting me hit it? Whatever. That's coming out. Okay, August 4th estimated date. So we'll see when that happens. But that's kind of your next. Now you're going to get into some earnings. Now you're going to get into some good stuff. Let's look at. I'm very curious to see. I want to see Amazon earnings when this date is going to be, because I believe that all of this stuff is coming like in the next couple of weeks. Let's see if I can find something. I don't know. Let's see if I can go. I'll go to the chart and see if it's up on the chart on Amazon. What do we got here? Earnings, does it have? Yeah, here it is. What do we got here? The 28th of July. So that's right on the GDP date. So a couple weeks from now. I got rid of these volume profiles. Let me put them back up. Put these volume profiles back up. But yeah, Amazon's got some range, man. I mean, this thing is a really interesting setup. Obviously, we said the same thing I feel like we said the same thing last time going into earnings and what happened last time. Because we were sitting on this like really interesting, like, holding these lows right here on Amazon. And then you just had earnings that was the annihilation that just said, whoop, we're going down. Now, same deal, same exact situation, right? You've got these nice, lows that are holding right here around $100 on Amazon, now post-split adjusted price. But now you're going into earnings. If the market's in this limbo and this thing has a bad earnings, whoop, could be setting up for the downside. I'm curious to see how much this was priced in and how much is not on some of these stocks, because going into this earnings season, I think a lot of people are ready for like this to be not great, things to look pretty bad. But I'm curious to see how the reactions are if we do continue to see this just waterfall to the downside, these 20%, losers on earnings, 10+ percenters on some large caps. If that continues, then yeah, we can certainly see more downside in the S&P for sure. If they're going to keep selling off by 15, 20% off their earnings, and they're already down from their highs a good chunk. MKFG. Let's take a look at this chart. Interesting, because it's trying to build a bottom. So what is this? This thing has gotten annihilated. You can't deny that. But if it holds this low, decent chunk of volume came in as of late, holds this low around 170, 172 is your spot. Starting to curl. But yeah, it's not a bad risk reward. The upside here could be huge because, maybe a 50 SMA touch, which, risk reward on that, do the math from here, risk these lows. So whatever that is, and then 50 SMA target. So, you're, the really good trade. You guys might be able to see it's pretty small, but the risk reward ratio is a 2.21. So anything over two is in my view a valid play, as long as you're going to keep that downside nice and tight. So it could be a good play, but you are speculating. Like there's been no trend break here. You still got lower highs and nothing has necessarily changed. So from a momentum standpoint, momentum is just is negative. It's down. So until you could take a guess, and I've taken many guesses over the past 6 months, and many of them have been wrong. Right? And sometimes eventually you're going to catch it. You're waiting for that big reversal, but you can take a lot of paper cuts along the way until you eventually hit it. So it's up to you on how you want to play it. But personally, yeah, if you had a fundamental approach into it too, and your fundamentals made sense, and they kind of backed up into your technical look and said, okay, well, here are the reasons why I think this reverses now, and you have reasons to believe that. Okay, maybe that makes more sense, and you can play it versus that low. So that's all I would say, like in terms of positioning yourself into something like that. And then PBI. This thing is trying to hold up here, but this same deal. But you kind of had this bear flag, right? So you had this move down, right here into your bear flag to the downside, and now you're breaking down. We didn't get a huge extension down on this guy. Nothing crazy, but they pay a dividend. They pay a nice dividend too on PBI. It's an interesting stock, really, because of that dividend, I believe. It's getting down to an interesting spot, man. This is getting down. I mean, it could totally come down. COVID time was back here in the ones, so it could come down more. But until you break back up, I would want to see this thing getting above the 50 SMA, really, with some strength, and then see these trends break, ideally. Let's see. Do you think markets are just in survivor mode? I think there's a lot of reasons to believe that we should go lower, and I think that it's very valid and probably should, to be honest, in the overall markets. The only thing is that it doesn't always work that way, and we haven't really had, to be honest, a really nice bear market rally that really suckered everybody in. So my gut here is we could see 350, maybe whatever, in a post CPI if it's really bad or the Fed says whatever happens. But to see below 350, my gut is telling me that we're going to need to see a pretty substantial rally. So maybe CPI sends us to 350 or so, give or take a few bucks, whatever. But then from there, I think we can potentially get a really nice rally back up into maybe the 400 area or even upper threes. It'll be a pretty nice spot up in here to sucker everybody in. And then we go back and go lower if we're going to go lower. So that's kind of my take, on the overall markets in terms of survival. But we are forward looking, and I think we are potentially setting up on a Fed pivot very, very soon. I mean, we'll see what GDP comes in as. We'll see what CPI comes in as, and we'll see if oil keeps coming down. If oil keeps coming down, gas prices come down, very, very helpful for CPI. Fed's not going to be freaking out as much, potentially. So if that all happens, great. Then on top of that, how the next couple CPIs stack up. And if it's not that bad, Fed may pivot in the next few months and say, wait a second, guys, we're in a recession, technically speaking. Let's say we do hit one, and we are in one after quarter two. GDP comes out. We're in a recession, not good. We are seeing other areas of the economy that are, spiraling out of control. We need to slow down if we want to essentially. The whole soft landing thing, I don't want to say it's BS, and it kind of is, right? But it's like what they're doing right now. Let's just say for all intents and purposes, we're on a boat. I think a boat's easier to envision. Well, you're on a boat, and this boat is flying along, right, at whatever speed. Let's say it's 50 miles per hour. It's going at 50 miles per hour. What the Fed's doing right now, it's like inflation, the economy, everything, right? It was like ramping, and then all of a sudden, all the money pumped in. They are like smashing that brake and taking it from 50. And now, like, if we have to raise by 100 basis points, if CPI is that bad, or let's say we raise by 75 again, they're bringing that thing in. They're hitting that brake hard. And what's going to happen is, like, when you do that, you're jostling everybody on the boat back and forth. Everyone's flying out of the boat, right? Whatever's happening. People are, like, freaking out. And so you're at some point going to have to let off that brake a little bit. Doesn't mean go back to 50 miles per hour, but let off if you want to kind of gauge and test the waters a bit. I don't think it's going to be, you're just going to be able to easily kind of ease us in and slow it down nice and easy. You're kind of gauging. Like there's a spot, like let's say there's like a boat coming up straight ahead and we can't turn. We're going straight into that boat, right? How fast do we need to slow our boat down to keep everybody in our boat without flying out, right? And so that we don't hit the boat in front of us and we can ease into that soft landing, as the Fed says, and ease into that soft move into not crashing. That's kind of how I envision it. And so I don't think, if anyone has experience even just driving a car, you don't just you can obviously smash the brakes, everyone jolts or whatever, but there's like a test. Like you hit the brakes, you slow down, and then you gauge, right? How fast is the car ahead of you approaching you? Are you coming up to them too fast? And then you let off the brake. Maybe you have to get back on the gas if they start speeding up, and you kind of have to adjust. And so it's going to be kind of back and forth. So I wouldn't be surprised if they take a month off or they drop the rate hikes back down to a 25 or whatever in a month or two or in a couple months, and they feel out how that affects things and see where things are shaping up. That's just kind of my take on the whole thing. So, you're kind of push and pull a little bit. So we'll see how that shapes up. CVNA Carvana, man, this is going to be interesting because I know that this thing has gotten annihilated. There were some people I was seeing on Twitter, and I remember seeing them, and they were talking without taking a short here on Carvana. I'm looking at this, and we got a double bottom. So until this double bottom breaks and Carvana drops below $20, I mean, there's enough volatility here. This thing can make some substantial moves up and down. Just be careful. They got earnings coming up into August, I believe. So this chart just looks to me like short squeeze central. I mean, this could be, you could squeeze Carvana to $100, like I think without much problem, without much real, true like fundamental reasoning either, just from a chart approach. This thing could be setting up for that. So that's my only concern on Carvana. I think under $20, the floor breaks and you could be heading down to, 18, 15, something like that. And we'll see from there how the market stabilizes and whatever. But the car market's going to be an interesting spot. I'm really excited to see those numbers on CPI this coming week. So where the used car market's at, because that was pretty weak. It was actually up month to month last month or on last reading. I'd be very curious to see if it's up again. I don't think it will be, but I'm very curious to see if it is up again. So let's see. What do you think of Oxy? I mean, here's the thing. Warren Buffett loves it, right? OXY. But just because he's buying this thing now doesn't mean that this thing has to hold up. If oil starts cracking down, I think this is going to crack down. Right now it's still building higher lows. It's still strong. I mean, you can't deny that. You are building these higher lows. You are showing strength here on this guy, right? So here's a low right here. Here's a higher low right here. Here's a double bottom, higher low, right? If oil cracks down back under $100 and starts to fall off, and it's like, oh shoot, here goes oil, it's going. Yeah, I mean, this is probably going to break down and potentially could come down, for all we know, back down like $40. But what is Buffett going to do? He's going to buy. He's going to keep buying. He's going to buy. And in 6 years, if Oxy's at $100, he's like, oh, okay, cool. Like, you know what I mean? Like, so he doesn't care. So that's my only thing. I don't like it right now. I really don't with oil. I would be very cautious of that stuff right now. But it depends on your horizon. If you have got a massive time horizon, then who cares? Buy stuff buy solid companies that you believe are going to be holding up for the years to come. But if you don't believe, then don't buy it. Leave it alone. And I think we've all noticed too. If you have those questions and you're kind of concerned about something, and you're like, oh man, I'm not sure. Just wait. You know what I mean? That's the biggest. I was reading this book today. This a very very mental game of. Well, I forget what it's called. The mental game of trading, I think it's called. Mental game of trading. And essentially one of the biggest things, at least in terms of greed, a big greed factor that I recognized now after the fact, after the past couple of years, of one of the biggest problems I have had. There's always things you can improve on. But it's that I have this weird feeling of, if I'm not in something, my money is just is melting away, right? Inflation, everyone's all worried. But now I've completely shifted out of that to if I got to sit on a ton of money cash, I don't care. I'll wait for the next opportunity. And I don't care. Instead of having to always feel like it must be working for me. If I don't have confidence, if I don't know, if I don't feel good about this play or that play or this stock or that stock, then I will wait. I will step back. If I miss something, I can learn from that, whatever. If I don't, my biggest mistake has been always feeling like I had to be in something. So what that ends up making you do is you kind of just start buying dips. You start buying dips, and the dip keeps dipping and dipping. And then all of a sudden, here we are 6 months later, and now things are much, much lower. Obviously, for a long-term investing approach, dollar cost average, fine, do your thing. If you want to, no, not even if you want to, just buy solid companies, buy solid, businesses, buy ETFs, buy things that you don't have to worry about, that you can stash away and whatever. But if you're trying to make money off the volatility, then there's no need to feel like you must always be in a trade or in a position to swing or a this or that. You do not have to be. So that's what I would say is that's a big factor into greed. It's like a big, you always feel like you have this overambitious, mindset, and you always feel like you need to be doing something. And when your money's not doing something for you and it's sitting cash, you feel like it's actually prohibiting your growth, when realistically it's actually probably saving your ass from making a stupid mistake. So that is something to think about too when it comes to anything really right now. If you don't feel like super, super pumped about it, then don't take it. DRV is a good one. DRV, I really, you can tell, want to short the real estate market. Here's my concern. If we got a rally in the stock market, and if we saw, like, let's say the 10-year and the 30-year rate, if bonds continue to keep pulling back like they were like last week or a week and a half ago, right? This is going to come down. So this is DRV. DRV is a 3x bear ETF for real estate. So this goes up when the Dow Jones real estate ETF or whatever goes down. So essentially, right, I really want to play. I think this thing could go from, I don't know, $50 to 100 plus, in the next couple years or a year or so. This is like a big picture swing, or big picture more so an investment. You know what I mean? Positioning yourself to play the backside of real estate. Always risky. It's risky. I wouldn't be putting my entire portfolio in, but I really like the play. I really like the idea. But I just have this gut that's pulling me back, this hesitation, so I'm going to wait. I could start to potentially dollar cost average in here under $50 and play it this way, right? Take an ad right here. Let's just say I want to get a $3,000 to $5,000 position size. Okay, I'll take a buy right there at 48 or 49. I'll buy at 40, and then I'll buy at 30. I'll buy 3 times. I'll buy $1,500 each time. And then at that point in time, I'll have a nice average somewhere here in the 40-ish range. And then I'll look to play this thing for a move back to the upside as if I think real estate's going to come down or correct further. That could be the play. I don't know if we ever get back down here. To be honest, we're probably not going to get back down there that low. But, I want to get a better entry, so I've been feeling greedy. I think we can get closer to $40. I know that might be a stretch. Maybe I'm wrong. Maybe it goes without me. Same thing I thought back when we had the whole Bitcoin situation. I wanted to short Mara. Really wanted to short Mara. Didn't feel super confident about it at the time, back when Mara was right here, because I was looking for Mara to make a bigger move up to 50 plus, and then I would look to short it over $50. Well, what happened to Mara? Well, Mara went from that $30 area all the way down to sub 6, and then, would have been a great short. So you missed out on the opportunity. Is what it is. So what? You miss out. You move on. You learn from it, right? But if you don't have that confident feeling, then step back. There's knowing to play it. And then that's kind of how I feel about a lot of stuff. And it would have saved you a ton on a lot of stocks over the past, couple of months, especially, let's say, in Amazon. Let's say you liked Amazon for a swing and you were trying to get an Amazon calls or whatever you wanted, right? And Amazon's holding up really, really nice right here. And I'm like, well, this chart looks really good. I liked it back here. I'm like, well, it's holding the lows. It looks really good. But then I'm like, well, what's my hesitation here? Earnings. Earnings comes out in a couple of days. I can't control that. If it happens, well, it's going to happen in the after hours. There's nothing I could literally do if Amazon starts crashing and I had calls. So I'm not going to take calls at this point, right? And you wait, and great. Now you got a better entry here, and same deal again, right? Amazon's setting up, looks really nice versus $100, but earnings are looming. CPI is looming. You could just wait, unless Amazon's a stock. I think, to be honest, it's probably fine to DCA, dollar cost average, into anyway, right? But if you're trying to time it for like a swing trade or buy some options that have an expiration date, you want to try to do your best to get yourself in the best possible position for that trade to work. So that's my my word of advice, I would say. All right. DWAC and Fun simply runs against a Twitter fall. Yeah, I wouldn't be surprised this past week or this week if DWAC pops off. If this pops off, DWAC, which, by the way, chart-wise looks like a nice bottom look, to be honest, right here, sitting here. What is this at? Like freaking $25 a share. I wanted to short it back, a while ago, but whatever, missed the chance. This could bounce, a few bucks pretty quick, and then I would look at Fun. Even Mark, M-A-R-K, I think is another one that also runs with them, Sympathy. So there's those to look at. But yeah, that whole Twitter thing is just like a mess. I don't even know. Like, it just seems like there's too much weird BS going on. Maybe Musk is trying to, secretly try to, snag a better deal, which I wouldn't be surprised. So I don't know. I'm just, I'm not playing Twitter. I'm not touching Twitter, really, is all I'm saying. But if DWAC runs, then hey, the Sympathy plays are Fun, PHUN, and I'll look at those. PHUN. which, by the way, I think it's actually curling up. It's got some decent volume the past couple of days off the lows versus $1. Not a bad risk reward. This thing could pop. This thing has made some crazy runs back in the DWAC run. Like, look at this thing. Fun, this is nuts. When Fun made this run from $1 to $20, I literally lost. I could not believe what I saw. Now, it happened extremely, brief, but I could not believe what I was seeing. I think I was traveling. It was October of last year. I was traveling to a Penn State game. And I was like just watching DWAC go. I was like, oh man, that's nuts. And I didn't believe it was going to keep going. And then I was looking around like, oh my gosh, I didn't even see Fun was up, however many 1,000%, 2,000%. Mark was up, MARK. This is a great one I've played to short. Mark was up a ton. The short side of this off of any of those DWAC pops are good, but it needs to get a big move. I don't want to play this thing like, shorting it here is not worth it, in my view. It needs to get a pretty big pop for you to want to short it, for me to want to short it. But even that, probably would leave it alone. My current plan is I want to use the Interactive Brokers account just for shorting. So we have to fund that. I think, I have a minimum of $2,000 in there. So I'm going to fund that with $2,000 at some point. Not a super high priority right now when the market's been this nasty, because I'm not really in the market to try to start shorting everything left and right small cap land. There's just too many, and it would be mostly for small cap shorts. I'll take, put plays or whatever on my other account, whatever, Webull or, any other, whatever. But yeah, I'm pretty much looking to play just short small caps there. Hard to bar rates and all that stuff, some whole other side of things, and so it could be a challenge. So that's the idea, to keep it all separate in one place, so you're not doing it and utilizing buying power and whatever from other places when you're doing so. But yeah, the risk reward on some of these things is not there. I would want to see a couple months of either a return to the mean. Small caps start making some good runs, they start popping off, and we start getting a lot of runners, which would be great, because when you have 5 or 6 runners in a day, they're all not going to hold up. Look for the weak links, find the plays that have highest chance of an offering. The weaker names, those are the ones you can short. Lesser volume starts to fade, other names get picked up, and then you can find those weak links, and that's opportunity. There's opportunity there. But for now, there just hasn't been enough of that for me to feel like, oh yeah, I really think that this is a great shorting environment or market for all the small caps. There's opportunities every day for sure. But I'm looking for a different kind, I guess, of setup specifically. So we're not totally seeing that. So I'll wait, again, patiently wait for that. Was looking at my trading journaling videos, my phone from months ago, laughing, pretty melted rally. Yeah. Well, no, it just tells you the whole melt up rally we talked about was from literally there's some people out there who are on that camp and still believe it, and it could still totally happen for all we know. But it just shows you when you trust or when you believe and what you see is one, you trick your mind to see one thing. You got to look at the chart and let the chart tell you what the heck is going on. So for me, I got a couple levels, charted out. I kind of have a good feel this week. Whatever happens on Wednesday, going into Wednesday, I'll have a good feel and essentially let the chart, let the momentum, let what's happening, let sentiment dictate my next move. So for now, we chill, we wait, because I don't have a good feel into CPI. There's no need to guess, in my view. We wait. Let's see. Always have to be. No, we all experience that. Beach Drum's heading out. Peace. Have a great week, great weekend, or last couple hours of the weekend. Carvana looks like it could totally be. I'd be careful of long term, but I would say if it holds these levels, it could be a squeeze for sure. XELA bottom increasing volume. Let's take a look. My eyes have been watering the entire afternoon here because I was grilling. We were just grilling a couple hours ago, some burgers, and I was just taking the smoke to the face. And so now it's I just feel like it feels like I have a cold. My sinuses are all stuffy and messed up. My eyes have been watering, all from grilling some burgers, man. I guess you grilling some burgers in 100 degrees, you're asking for it, but 110 degrees. XCLA is pretty, the volume is there. Obviously it's up, but this thing is this chart is wonky. This thing has gotten annihilated, down to 10 cents. The risk, the concern I have on this is the reverse stock split. It's coming. Like I don't know. I haven't looked into them. It's coming. If it can hold 10 cents, maybe it's a good risk reward. But the reverse stock split is coming on all these things, unless they want to end up just delisting. But that's the thing. So you're waiting for a reverse stock split on XCLA. Be careful about that. I got Grill obviously as my small caps. I like the play, whatever, but if they can't pop this week, I'm selling half. And if they don't pop next week, I'm selling the other half because they had until August 1st to get the minimum bid requirement over a buck, and they're not gonna get there. So I would be cautious on that on some of these super cheap names that have been here for a while in the cheap range. Just be careful. Just curious, trading ETFs, you charge their expense ratio per trade monthly. I'm not sure if you're trading ETFs. I don't know. I would have to double check back through my logs and history. I don't know. That's a good question though. To be honest though, it's such a small number, like in the grand scheme of the trade. I don't really care. If it's when you're talking about like those for like long-term investments, the bigger concern that I see for that is like if you're buying stuff that has high expense ratios, it could be eating into your compound interest, or your compound of profits, your compound of gains, your compounding of your accounts, big picture. So whatever. YouTube on the right is telling me now would be a good time to insert ads. Should I do it? And I'm not going to do that. I'm I'm not a dick. That's funny. That's funny that they give me notifications to I didn't even know you could drop ads midstream. Like I'm literally live. You can drop an ad right now. That's like, that sucks. Like, I mean, I guess if I was jumping off and had to go to the bathroom, maybe, but why would I do that? HSTO. HSTO is a penny stock, I believe. Let's take a look at it. 1 year chart. But because of that, all I ask in return, I won't hit the ads, but drop a like. If you guys hit the like button, that's awesome. That's all we ask for. We appreciate that ton. Let's see. HSTO. Auto, this bad boy. Curling. Nice higher lows here. It's curling. Got some volume. A little bit of volume. Let's jump in. Adjust this chart so we can see. 50 SMA is at just shy of $3. And then there's a gap fill. So this is the spot I would targeting. Gap fill up here towards 315. So that's your spot. Up towards $3 is where I would be looking to be careful if it starts to show some weakness. But that's not a bad spot on that guy, up to about 315. Beyond that, next spot after that will be up here towards like $4. The lows that we saw back here from this bounce, or really from, it was surprising. January into March, this thing actually held up pretty well. But yeah, that's $4. So if it breaks through this 3, fills this gap and keeps going, $4 is next. Will be the spot to watch. By the way, as we're speaking here, futures are coming down a decent amount. Nothing crazy, but it's coming down. So S&P futures are pulling back. Here's the chart. Look, we're still a few minutes delayed here. Let me just take a look at what the... so now we're seeing here on investing.com. Dow futures, S&P, they're still not down 0.5%. NASDAQ, tech's gone down about 0.5%. So there's that. Small caps a little bit more. VIX is now up a 1.5, almost 1.25, or a little over 1.25. So there's that. Again, this is nothing crazy. If this trend continues all the way overnight, okay, then that's something that we can more meaningful into tomorrow morning. But this isn't like huge moves that like the market can bounce back in 2 seconds, really, or not 2 seconds, but it can bounce back fairly fast on that. So don't be too concerned about it. I wouldn't be too worried about it. It's still kind of flatlining. If we break below, let's see, on this area right here, like 388.0, yeah, 3880 on the S&P is kind of the interesting spot. If that breaks down, maybe we're testing down towards 3870, and then we can see a stair. We still got, it's not moving too much. We'll see. Oil is pumping down a little bit, pulling back a little bit right now in the futures. Let's see what oil is doing. Yeah, it's getting rejected here at this 105. That's the spot. I mean, I expect that to be a really interesting spot. This 105 is that trend line area that was support for the past couple of months. We broke below. Now it's resistance. So that 105 is your spot That's your line in the sand. Over 105 and it starts to build, I would get out of any oil shorts just from a trade perspective. But if it can stay, it respects that 105 as a resistance, give or take about $1 or so, is kind of how I see it this week. Then I think we can be heading down potentially lower on oil. So just something to think about. All right. Just joined. Think about puts on SPY Friday to catch the high CPI. We talked about that earlier. For those who are jumping in now, I think it's important to also mention this and go back to it. It's the obvious trade. Just think about it. It's the obvious trade. Doesn't mean that it won't happen, but it's the obvious trade. I mean, we look at sentiment last week, so bearish, very minimal bulls there, heavily overweighted to the bearish side. It's been that way for a long time. CPI is not going to be good. We looked at this. Reuters is saying 8.7% is their estimate. Bloomberg's is 8.9, up towards around 9, something like that from Bloomberg. They're expecting nearly 9%. That's the expectation. So we need to probably see a 9.0 or higher, in my guess, for true panic to set in off of this number. Because they're kind of expecting and projecting it to be high. So that's the only concern. So there's a couple scenarios. I mean, we talked about before. I'll mention them again. Here's the gap fill. Big question mark. Does it happen? If it happens Monday or Tuesday, great. Sell into that. That's what I'm going to do. Sell into that, and that's it. And then let things kind of play out for CPI. Have some more cash, and we can play the game after if we have a better feel on things. CPI comes out. We pull back to this 380 area. You get the brush. Pull back to 380. And then for whatever reason, everyone's like, wait a second, we're building higher lows, we're bouncing here, we're kind of holding up, and then all of a sudden we start curling. You can get a pretty big short squeeze on that. I wouldn't be surprised. So that's kind of one scenario. Next scenario will be if we do break below this 380 on SPY, which was the lows back here from May, then I'm looking down towards 372. If that area can hold, okay, cool. We're technically still building a higher low off the lows, and we're fine. That breaks. And then 370 breaks, good chance we come down and test these lows. Careful for a double bottom. There will be some support here at around 362 on SPY. If that breaks, you're probably coming into the 350s. And I think it may be a psychological 350 spot for a possible next target to the downside. Those are the scenarios. So if we start breaking down, I'm ready to go on the puts, to play puts, if I really like them and if I like the idea. I would just not be buying this Friday's expiration. That's just me, though. Again, everyone is different. If it's a day trade, sure, buy this Friday's expiration because you're going to be out by the end of the day anyway, so who cares? That's the play. If it's a swing and you're looking bigger picture, I would go out to next month. I would go out into August. That's what I'm going to do. On any playing SPY or QQQ or IW, I'll go out to August. That's it. So I'm not going to play something that's that short of expiration. If the move we get in a couple days, great. Awesome. I'll lock in gains. I just don't want to have as much of a volatile contract personally. But that's the idea. So don't be, not sitting here saying, oh, perma bull. I don't really care. I let what happens, right? Obviously, we all would probably make more money in long-term investing if things went up, right? But in the short term, right, you're going to have volatility. Perma bull, BS, whatever aside, don't be surprised because we know oil is coming down. So if we know gas is coming down off of where it was last month, all of those things are coming down. Those are big players in CPI. So if energy comes down, a whole energy category of CPI comes down substantially next month, the market might look past this reading of whatever, 8.79, whatever the number is, if it's in that upper eights. The projection is that it's going to beat last month, okay? Believe it or not, that's the projection. Market might already be a couple weeks ahead of that, a month ahead, a couple months ahead. It really is months ahead, but market might be ahead of that and be looking out to the next CPI, which they know is coming down. So that's the only concern, is that I think the market's already forward-looking enough potentially to look past this CPI. The only difference would be if the CPI is bad enough for the Fed to do an emergency hike or for the sentiment to shift from the Fed raising 75 to the Fed raising 100. Let me pull that up. Here is the current Fed projection or whatever probabilities for the next rate hike. So next meeting is in 16 days, 16 hours. There's a countdown. So this is, believe it or not, yeah. So actually it's shifted this way. So 90% chance of a 75 basis point hike, but we're actually seeing a potential 9.4% chance now of a 100 basis point hike, believe it or not. So this CPI on Wednesday is going to change these bars, in my view, from either 90% a 75, or we're going to shift in a big way very, very fast towards a much higher percentage point probability for the 100 or for the 100 basis point hike, believe it or not. So that's the thing. If this, starts, if the consensus view is that the Fed is going to do the 100, then yeah, I would say that's market's coming down, because that has not, I don't know if that's been priced in enough. The 75, past couple of weeks, we've been expecting a 75 past couple of weeks. So we know that. But if now all of a sudden we've been expecting a 75, we're going to be getting 100, look out. Uh-oh. Market's not like that. Now, how bad does the market pull back because a lot of other factors? That's the next question, but that's what we're watching, really. 10-year, here's a 10-year. The 10-year treasurer, 10-year bond yield is at like this 3.1, 3.09. That's your spot. I'm watching for a head and shoulder setup. We really won't know for a bit, but 320 to 325. So if this area right here becomes resistance for the 10-year yield, if this ends up being what happens, then you have your head and shoulders. You have your left shoulder, you've got your head, right shoulder, and then we could be looking for a breakdown below 270 and rates come down substantially. That's my concern for looking at the real estate short. That's my concern for a couple of different things, because it's the obvious play. The obvious play is, oh no, this is gonna go up. Rates are going way up, right? There's no reason for the Fed to pivot just yet. But I think we're starting to see more of that. And I think that with oil coming down, it's going to be very helpful. So we'll see if that holds up. Meanwhile, DXY, the dollar index, killing it. We'll see how this plays out this week. This has been super, super strong. It's getting very overextended. Just be careful here with this. We'll see how it shapes up. This is getting very, very, very parabolic. You know what I mean? This chart looks more and more parabolic the more I look at this. So it's still strong. 50 SMA support, which is down here towards like 104, but it's extending a lot. So just be careful if playing something related to that. There may be some weakness in the dollar at some point. There will be at some point. So there's that. I don't trade crypto very much. All I do is right now, actually, as Bitcoin pulled back, I initiated some recurring buys in some portfolios. That's really it. So now I'm just recurrently every week buying Bitcoin, doing it in the Robinhood portfolio. We like the covered call portfolio is what that really is, but I'm doing that there every week, a few bucks, just to scale with the port. I could probably up that these days, but I'm not going to up that right now. I'm going to leave it what it's at, because just let it recurring buy, and that's it. That's it for Bitcoin. There's no, for me, we could totally go way lower on this thing, and I don't really care to try to guess. I'm letting let it play out. If it goes down to 10K, great. I'll buy some at 10K. Sure. I don't have very much. Not a Bitcoin guy. Not that I'm against it, but I'm not like one of those Bitcoin guys who just made a ton of money on Bitcoin and lost it all, whatever. So we'll see. Insert ad to make money. Yeah, I should make some money, and market's been tough, right? I should insert an ad. Purchasing another decent drop is coming pretty soon. Hey, we'll see what happens. I wouldn't be surprised. Right now we're in limbo. In my view, we're in limbo. We're in a limbo with CPI looming. Is it worth trying to guess? I don't know. There'll be plenty to make on the backside of CPI, on the downside or the upside, whichever way we go. So there's a lot of, there's patience. This is all. There's great opportunities maybe intraday for like a day trade if you really want to take a day trade on Monday, Tuesday, Wednesday, or whatever. And then after Wednesday, we'll stream for CPI. We'll have a stream for CPI. So make sure hit the thumbs up button on this stream, which is key and helps out a ton. But subscribe if you want to, and notification bell if you want to. But we'll do a stream for that. We usually stream Monday, Wednesday, Friday for Power Hour, the last hour of trading. If I'm making any, moves myself, I'll, obviously do them live and whatever. And so we usually do, but, pretty chill, laid back, nothing crazy. No, like, oh my gosh, like not sitting here, freaking out. We're not panicking. We're not, going nuts. Maybe we should have some more fun. We could definitely have some more fun, I think, but, it's pretty laid back. and we'll have a better idea, and not, at least I'll be kind of walking through my thoughts and game plan after CPI, and see what I want to do. But bigger picture, I'm looking for this ultimately on a bear market rally. I really want to see a bear market rally up to this trend line. I really want to see that. If we get that, that's what I'm looking for, and that will be very, very telling. That bear market rally will be very, very telling to say, okay, do we just trap a bunch of people who felt really good about the market, and all of a sudden we end up going lower? Let's just say, right, we dip, we bounce back up. We're up here, right? Now the question is going to be, is everyone feeling bullish? If everyone starts feeling really, really bullish right here, guess what? We probably head back down. If everyone's like, nope, this is a bear market rally, sentiment's still negative, it's really, really bad, nope, not going to happen, I could see us squeeze right through. That's just from a psychology point. I mean, of view, I think that's what we're going to look at. But we'll see when we get that. We got to get a big rally for that to happen. We haven't had one really since March, so we'll see. But I think you need a sentiment moving rally, right? We haven't had a sentiment moving rally. Sentiment has just been fear, extreme fear. We've actually, fear and greed has moved a little bit out of that level, but it's been down here. It's been bad. Sentiment has been this bad, has been bad for a long time. A sentiment shifting rally changes things and potentially offers an edge, right, as we move forward. So that's what I want to see. We haven't gotten it. We've been down this low for this long, which historically speaking tends to line up with bigger picture bottoms, believe it or not, whether you want to agree with that or not. I mean, you just go back through history and look, but whether you agree that it's going to happen or not, I guess, put your cards on the table and play the, shorts or longs, right? But at the end of the day, but that's where we're at least on that standpoint or that point of view. Futures are pulling, and they're just kind of chilling right now, down about 0.5%, just about 0.5% on the S&P. Let's jump back to where is it? Here it is. Yeah, I mean, nothing crazy. We'll see if this holds up, but this can be, snap back and, at the open. I would really love to see us be green Monday, Tuesday. And if we are really strongly green Monday, Tuesday, that's setting you up to hedge. That's setting you up for puts. I mean, if we are, I would immediately, as I said, I'll sell any of my August calls. I'll sell any of my, I think I have, August is the soonest expirations that I have on anything. I'll sell my August calls. I might even trim other positions a little bit. And then I'll buy like an SQQQ call hedge or something like that, you know what I mean? Or a SPY put hedge, I'll grab a hedge like that and boom, I'll chill with that. If we rally hard, if we get a nice push, honestly, on the S&P, closer to 4,000, on SPY, close to 400. If we get that move, that's looking really good, for a short play, in my view. So I would love to see that come into Wednesday, but chances, realistic, let's think what's going to happen. People are probably going to be like, okay, CPI is coming. Let me make sure I'm positioned. Let me play the short side. So either we're going to see very low volume chop, or I would say some profit taking into CPI, or whatever, or just some, shorting into CPI, whatever. That's my guess. If I really had to guess, I would love to see us push up so we can position on the short side with a better risk reward. But if we can't, we can't. It is what it is. You can predict, but need to be faster to react. Exactly. Market moves quicker than most can react. Yes, that's going to be. That's going to be how the CPI kind of goes, I'm guessing. So we'll see. It's the funny thing is though, if we get past the CPI, we're going to get past the CPI, and it's like, okay, here we go. We're past CPI. Whether we go down, up, whatever happens, and then it's like, earnings season. And it's like, oh, I forgot about earnings season. Like everyone forgot about how that was last time. Well, it's time to go again. Earnings season's coming on our doorstep. It's time to play. And we're about to have some more fun with that, right? So we'll see. I really would love us if we did, get oversold again and really sell off after CPI. Great. There'll be a great reversal play to play off that at some point in the coming weeks as well. So expecting rally hard in second half. I think there actually, I've seen some people with a similar agree. Not many. I'm just saying I've seen some on Twitter, just from strolling through some stuff with a similar approach, thinking that we're gonna get a nice rally here, but they're thinking that we're gonna see some weakness here in the short term. I wouldn't be surprised. I could see that. My only concern behind that would be if the market is forward looking enough to look past this CPI, even if it's really bad. That's my only thing. If this CPI is really bad and market's able to look past that, then the rally comes, I think, now. If not, then we probably sell off first and then we can potentially rally. And then I would imagine too, if we sell off hard from here, I would imagine oil comes as well. Oil is going to come with the market. And then next CPI, that thing is coming tanking because gas is going to be coming down. If the second half of July is that trend continues down for oil and gas, your next CPI reading is going to be really, really nice. Relative, right? It's going to be a big sigh of relief. And the question will be, will that continue? But then I think what's going to happen is oil and gas key in the short term. Obviously, if it spikes back up, it's going to put pressure on CPI, whatever happens in whatever few months. Key in the short term, and then you start getting into the effects of these rate hikes are going to start rolling into other categories of CPI in the coming months. So that's the forward-looking view of the markets. But I do agree that maybe in the short term there's enough panic to sell us down to new lows or down towards lows, and then we start looking ahead. Wait a second. CPIs are going to be coming down. We're rolling over. That could be the time for the rally. That could also line up if we do go into a recession by technical terms. 2 quarters in a row, negative GDP growth. The Fed may go, whoa, we got to slow down here. We're going to pull back. We're not going to raise as much anymore. Take a month off, maybe pull back to 25 basis point hikes. I don't know. They might have to say, wait a second. Yeah, CPI is still bad, but we also have other concerns in the economy. It's not just CPI. If they show signs like that, the market might like that, and that could be a rally point as well. We'll see. That's just my take on maybe how things shape up. Obviously, no one knows. No one knows shit at the end of the day. No one does. If anyone who's going to sit here and say, yeah, we're going to 426 tomorrow, no one has any idea. We can play off what we see. We can play off momentum. We can play off of our own speculation. We can have our own hunch. We can have our own plays, our own ideas. Sure, sometimes it's right. Sometimes it's wrong. You know what I mean? At the end of the day. So, that said, CPI is coming in higher. The question is how much higher? 8.7 here or closer to 9? That's your question. Anything over 9, market's probably dumping. And there's probably nothing to stop it. And in that case, this comes up. This chances of the Fed doing a 100 basis point hike, those are going to pop up if we see a 9 point something, right, on CPI. But that said, we've been going for like an hour and a half. I'm going to wrap things up here. I appreciate everyone for tuning in. Again, lives Monday, tomorrow for Power Hour, last hour of trading, and then Wednesday morning for CPI. We'll probably run one pretty long. We'll probably go into the market open until whatever time. That's the plan, and then Friday afternoon as well for CPI. For Power Hour, it's the same deal. But we shall see. This should be a fun week. Maybe we don't get as much volatility as we all were hoping for. No, I'm really hoping for it, but maybe we don't get as much volatility as maybe some were expecting. But it should be very, very telling, I think, and could be setting the stage for the next move, right? If we don't sell off as much as some are expecting or hoping with their puts, it could be setting the stage for a nice squeeze. That could be a nice rally in the next couple of weeks. So we shall see. Thanks so much for watching. I will see you guys tomorrow. Peace out. Have a great rest of your night, and let's get ready for a great week. Peace.